Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Sterling Chapman with Cashflow Capital. Thank you for your time, Sterling. I appreciate you coming on.
Thanks, Sakar. Thanks for having me. Appreciate being here.
Absolutely. So Sterling is with Cashflow Capital. He's based in Baton Rouge, Louisiana, and he's done lots of single family. He has started his journey towards multifamily as well. With Cashflow Capital, he has a partner as well. So he has a finance degree and an MBA from LSU, and he's currently going on with his journey with the syndication project. So we are welcome to have you at the show, Sterling. And you want to give us a quick background as to sort of your how your journey got started with real estate?
Sure. So I have an undergrad degree, like you said, from finance and LSU, but I didn't know what I wanted to be when I grew up. And I got recruited into insurance sales out of college. And I called myself a financial advisor, but really all I did was sold insurance and set up these little retirement accounts. And after doing that for a few years, I transitioned into the telecom industry, where I had a lot of success and shot up the corporate ladder rather quickly, and found myself, making more money than I ever thought I'd make. And I was telling my dad about it. He goes, "Well, that's great, but you need to figure out what to do with that money, because if you make a ton of money and then you don't have anything to show for it, you look dumber than if you didn't make any in the first place."
Right.
So, around that same time, my boss, who had been with the company for 17 years, had lost his job. They just do these corporate America does these restructurings all the time.
Sure.
And they just do layoffs, and it terrified me. I started to kind of have this vision. I was just in the process of buying my first house and about to get married and start a family. And I just had this vision of myself with like 3 kids in private school and a mortgage and car notes. And all of a sudden this corporate faucet that I built my entire life around just turned off on me, and it terrified me. So I was like, I need to figure out something else. And so I started reading personal finance books, and my wife thought I was crazy at the time, because the first book I read was, what's the real
Rich Dad,
No, that was the second one. The first book I read was
Think and Grow Rich.
No, it was the Dave Ramsey book.
Oh yeah,
about don't use any debt and don't use credit cards. So I was preaching to my wife that week, we're not going to have any credit cards. We're not going to have any debt. And then a week later, I read Rich Dad, Poor Dad, and I went back to her. I was like, scratch that. We're going to borrow as much money as we can.
That's funny.
She was like, I can't keep up with you. I had read Think and Grow Rich previously, and I'd always kind of been in the personal development. And it helped me a tremendous amount with my corporate career and moving up the ladder, and with my sales and with my leadership and with my goal setting. So I've always been a large fan of that. But so after I read Rich Dad, Poor Dad, I read a bunch of his advisor series on, I think Garrett Sutton's LLC book and Tom Wheelwright's tax book. And then I got into Bigger Pockets, and I started listening to, I must have listened to 200 episodes and read their books. And so I studied for about 6 months, and then I bought my first single family house. I put 15,000. I think I brought 14,000 to the closing table, and then spent a couple grand fixing it up. And I rented it out for $500 a month more than my note and my insurance and taxes.
Interesting.
So it's cash flowing $500 a month. In theory, it would have been like a 40% rate of return, but 2 weeks into it, I had like a $3,000 plumbing disaster that just wiped it all out. And then I turned around and I did like it was like the exact same deal again. I put another 15 grand down, spent 2 to 5 grand fixing it up. And then I cash flowed $600 over my note, taxes, and insurance.
Interesting. So is that something then you kind of got the taste of the first couple of deals and you said, hey, this works and I want to kind of keep doing it more and more? Is that kind of how you then expanded into single family a lot?
So it's funny because a couple things happened at that point. One, yeah, you're right. I was like, oh, this is really cool. I need to keep doing this over and over again. But the second thing that happened is I was broke because I just spent.
Oh, sure. Yeah, you drained your capital. Absolutely.
I just put down $40,000 and I just bought my personal house 3 months before that. So
I see.
I had completely wiped out any amount of savings. And it got to the point where I almost wanted to stop studying and stop reading about real estate because it made me mad that I couldn't go do more deals. And I knew I had to spend like 6 months to save up another down payment. But I decided to go in a different direction, and I read some books on low and no money down investing. And then I went and found, this was my first kind of taste of small multifamily. I went and found 2 duplexes. They were one had been flooded, one was just beaten up by a tenant, but they were next door to one another, and the same people owned both of them. And I think there was a wholesaler had his like number like stapled to the door or something. So I called him. I got him under contract. I had no idea how I was going to buy them. I surely didn't know how I would fix them up, but I had a friend that flips houses, and he was always like, oh man, if you want to buy rentals, let me find a beat up house and I'll flip you a rental. And then you like you were telling me before the program about how once a house is renovated, there's a lot lower maintenance, ongoing maintenance costs. And he was right. And it just, that deal, I always say that it made me, it worked out perfectly. So he had investor capital because he had been flipping houses for years. I had 2 rentals. Nobody was going to lend me any money. I didn't know what I was doing, but I said, go get money from your investors. Actually, his investors didn't have enough money either. So I got my brother to lend me another 40 grand to cap off finishing the deal. I said, and you renovate it and add me to the title, and I'll do a cash out refinance, and you can walk away with 50 grand in your pocket. I'll pay all the investors back, and I'll just keep the asset. And at the end of the deal, it worked out beautifully, just like that. Everybody won. The investor got his interest. My buddy that fixed it up and brought the investors to the table got his 50 grand. My brother got 6 grand on his 40 for 6 months. And I got, $390,000 worth of duplexes that I had $312,000 of debt on, but still,
there's a good spread between it.
Yeah, I walked away with $78,000 in equity, and it was cash flowing $2,000 a month. So
very sweet.
That was really when like the spark went off in my head, and I started to like kind of go 90 miles an hour from there. And I found some other. I ran into an older gentleman who was. He had 1031 his properties forever and didn't want to sell them outright because he didn't want to take a massive capital gains cut. And he didn't really have anything to do with the money anyway at that point. He just wanted to stop dealing with the maintenance on these old properties and have his retirement supplemented. So he gave me a bunch of properties, 10% down, seller financing on a 30-year amortization with a 10-year balloon.
Wow, that is sweet.
Yeah. So I bought a funny story about one of those properties. One of them I had my brother had some cash. He didn't know anything about real estate, but he wanted to get involved. So I have my primary company that I buy all my stuff in. And then I created a separate LLC where we bought some stuff together. And so one of these properties, it was 2 duplexes right next to each other, and they make up a lot of a certain size. I'm not exactly sure what the size is, but I own one of them, and then me and him own one of them together. And I didn't end up putting any money into this deal. It just the way it's worked out. Between my brother putting down payment and him seller financing most of it, like I didn't spend any money to get that. And the lot right next door to that just sold, and it's the exact same size as the lot that we have these 2 duplexes on, just sold for $350,000.
Wow.
So we only have like $120,000 in debt in this thing.
Wow.
So effectively,
You
could
have a
get it.
lot. Absolutely. Between lot and your house and everything, I think you
Yeah.
have substantially you can gain a lot of value in this.
So through 2019, through these partnerships and creative financing, I built up enough cash flow. Like I said, the original reason I got involved in this thing was to replace the income from my day job. Not that I didn't like my day job. It was just, I was afraid they might not like me one day. And I mean, it's possible. They're talking about layoffs right now. I'm going through it again, but I'm not as scared this time because I built up, $6,000 to $7,000 in cash flow over the last 2 years.
Sure.
So, if that happens, I'll be okay. And that was the original point. But 2019 ended, I had built up all this cash flow, but I didn't have a ton of equity and I wanted more equity. So this year, my two goals for 2020 was to get my first large apartment syndication under contract, which I'll go over that in a minute. But the other one was to build up my net worth. And I decided to do that through a series of BRRRRs. So, and that's buy, rent, rehab, refinance. I'm sure that's how you built your portfolio as well. But so I bought a house in March and we were in and out of it in 30 days.
Wow.
We bought it for 65 grand. We put 25 into it. So we were all in for 90. It reappraised for 130 and we pulled out 103 and rented it for 400 over the note.
Nice.
Then I bought another one that, bought it for 75. We're all in for 65. It just appraised for 209 and I'm pulling out 167 tomorrow.
Awesome. How are you finding these deals? Are these coming from wholesalers or
wholesalers? They're all coming from wholesale. And then I've got another one under contract that we just started construction on this week that should be similar. I should be able to get about 70 grand in equity out of the deal and cash flow a few hundred more. But yeah, all three of those came from three separate wholesalers. And I've never had to go. I've heard a lot of people going knocking on doors and sending mailers and cold calling, and I've always been willing to, but I've never had to because I just built these relationships with these wholesalers, and they keep every time I'm nearing the end of a deal and I'm ready to go get another one, it's like, all right, I guess I'm going to go cold call and knock on doors. And it seems like right when I say that, all of a sudden one just shows up in my inbox.
Sure. I think once you build relationships, I mean, whether it is, let's say wholesalers or, even good agents for that matter, I mean, there's no shortage of deals. That's for sure. I mean, with us, we came to a point where, boy, I mean, back in the years, I remember around 2012, 13 era, I remember I would be almost buying 12 to 13, 14 houses a month. And it was absolutely crazy that we would, because they were such good deals, we would buy them and we would still be finishing other projects. And there were times where these houses we were not even touching them for a couple of months because we were still finishing the other projects. So it's I mean, once it's one of those that if you get good deals, definitely buy them. And even if you can't like really work on them right away, it's not a bad idea to just hit a pause button on them for a few months and just quickly go back to them. I mean, we were at a point where we had, I think, 4 sets of contractors who were working on all kinds of different deals, and that is how we scaled up to all the way up to 200 all different between houses, townhouses, and things like that. So good. So Sterling, moving further, like I know now you're looking into syndications and trying to do larger multifamily projects now, right? So give us an idea as to what excites you with multifamily, and that's probably not as prevalent with single family. So give us some sort of pros and cons of why you like one versus the other, perhaps.
Sure. So I'll elaborate and give you kind of the evolution of how I got there.
Sure.
So as I'm in 2019, I was still self-managing everything. I still had a full-time day job. I was starting a podcast. I had a brand new baby and I was just slammed, taking care of all of that.
Absolutely. You must be swamped.
and I was like, I can't grow anymore. Like there's not an extra second in my day. How can I keep growing?
Right.
I can't keep doing everything myself. So I started like looking for, other ways to scale, and I came across multifamily. And
Sure.
initially I kind of liked, shopping in my own backyard. But when I started to look at the numbers and how people started to analyze that, like my backyard was really not the best place. I mean, first of all, I live in South Louisiana. A hurricane could come wipe out my entire portfolio tomorrow. Second of all, the South Louisiana, we're very heavily reliant on the oil industry. We saw what happened with that recently. That could come,
Sure.
and I mean that could decrease the occupancy of the city by 25% overnight.
Wow.
That's devastating.
Absolutely.
So, from a diversity standpoint, diversifying my portfolio across different markets was something that became important to me.
Sure.
From a time management standpoint, buying assets that could really support their own management outside of me was something
Sure.
that became important to me. And the ability to scale so largely was something that was important to me. And I love how commercial real estate is appraised, is what really got me. So
Sure.
I keep doing these houses, and I've fingers crossed, I've lucked out like every time. I've never had an appraisal come in low, but I don't sleep the night before because I know it's just, what does Jenny down the street think she wants to buy that house for? And it seems so like feeling or artsy based.
Sure.
And I'm more of an analytical numbers guy. And I like to know if I increase the net operating income by this many dollars, it is going to automatically make the value increase by this many dollars.
Sure.
There's a very scientific approach,
right.
With the residential appraisal method. It's very like, I always get subjective and objective mixed up, but I don't have as much control over it.
Sure.
It depends on the appraiser's mood that day. And that seems too much like gambling to me. I really like the mathematical scientific approach to the valuation of commercial assets. So I kicked it off with I'm a big Joe Fairless fan. I read his book on apartment syndication, which I'd recommend to anybody who's interested. And he had mentioned that, building your brand and establishing a thought leadership platform.
Sure.
So I started my podcast, the Rent Roll Radio Show, which has done great. And it's provided everything that he had promised in the book that it would. The exposure I've gotten to really successful investors has been awesome. So I always joke, some of these guys that I interview charge like $3,000 an hour for personal coaching sessions.
Sure.
And here, because I got a podcast, I could call them up and ask them whatever I want for an hour for free. So I've really enjoyed it. I've expanded my network in a huge way. When I started the syndication business, to establish my brand, I created Crestworth Capital, and I started everything on a shoestring. So I built the first website by myself. Hopefully that website will be taken down and replaced with the professional website that I just paid to have built by the time this episode airs. But I'm in no way a web designer. I've just gotten on GoDaddy, and next thing I knew, click here to add this, click here to add this. And so I built it by myself. And I tried editing the podcast by myself. That was about 2 days of me screaming before I found an editor for that.
Well, that's awesome. I mean, I like the fact, Sterling, that you are pointing out some things that are, very real for a lot of newbie investors, that you're starting out on a newbie, pretty much on a shoestring budget, and you're trying to every foot of the way you're properly bootstrapping, and also learning a lot, as you said, from Joe Fairless's book, which by the way, I read that, and it definitely is an eye-opener to a lot of details that perhaps get skipped from time to time, right? So with your podcast, the Rent Roll Radio podcast that you said, Sterling, for newbie investors who may not know, give us some maybe baby steps as to, how you go about setting that up, what type of equipment they need, or what type of editing that they may be looking for. Give us some ideas of how you kind of did those things.
So I the really, you don't need much equipment. So I have a $60 microphone that I bought. It was the one that Joe Fairless recommended in his book. It's an Audio Technica. I got on Amazon, and I think it was like $68, and it came with this little $10 stand. I everything else is on my computer, so I use a $20 set of. These aren't even Apple headphones. These are like some knockoff brand headphones. And I got a MacBook computer, which you don't need a MacBook computer. And
you still record all that there, right?
Yeah. So I originally bought that. I was debating whether to go with a Mac or a PC. I'd never used a Mac before, but I went back and forth forever. And initially my thought process was I was going to edit all this stuff myself, and I was going to use all the fancy equipment on the MacBook Pro. But I quickly learned that wasn't going to happen. And I found a guy on Upwork.com I was just looking for other people that would edit it.
So you want to delegate all the work because it's just...
Yeah, and he edits it for me. He also edits my videos and posts them on YouTube. And I think I pay him like it ranges by how long the audio lasts or the video lasts, but I on average about $75 a week every time I release an episode. But yeah, I use Podbeam. There's plenty of them out there. There's a buzz. I think I use Podbeam because my editor recommended it. I originally looked at some other hosting platforms, and he goes, "No,
for folks who may not know what Podbean is, could you maybe describe what Podbean is?"
Not fluently. It's a hosting platform for podcast. They basically store your audio and disperse it out to iTunes, and
so it's a syndication distribution type of podcasting platform. So
yeah.
Gotcha.
And it was, I don't know how much it cost, but it wasn't a lot. I mean, it couldn't have been $20. I don't remember the details.
No, that's fine. That's fine.
It wasn't an expensive process.
Right. And then moving further, Sterling, like how are you maybe now, since you're starting to, on your journey to syndications and things like that, give us some first steps as to, how you're reaching out to different brokers, how you're evaluating different submarkets and things like that. Initially, you pointed some things about, how your native town in Baton Rouge is, let's say heavily oil-based, or perhaps a hurricane could, impact you severely, right? Yeah. So talk about all that as to, how you went through picking out different submarkets that you're trying to evaluate. And now also, obviously, you're reaching out to brokers or property management companies and things like that. So give us an entire gamut of things, please.
Sure. So the first thing that you need to do is from what they say, is to pick out your markets. And when we looked at market analysis, I think everybody's got a different kind of refurbished version of the same thing. We use Neil Bawa's method, which is basically the same thing as Joe Fairless's method or Michael Blanc's method. But the key indicators that you want to look at in a market that you're investing in is you want positive population growth. You want to make sure that people are moving there and not moving away. That was the first red X on Louisiana where I live, is people are leaving the state. So obviously that's going to drive down competition, which is going to drive down rent growth, which is going to drive up vacancy. So the next thing you want to look at is job diversity. So you want, you mentioned the oil industry, and, think Detroit, where, it used to be a booming place, but then when the auto industry went down, now it's a ghost town. And if you have one major employer in an area and they move or they go out of business, I mean, the entire area could tank, and you could have massive vacancies that you can't overcome. So then the other thing is job growth that goes along with population growth and job
Sure.
diversity. You want people to be able to pay rents, and you want to
Right.
be able to pay higher rents. Also a decreasing crime rate. That's, that's one of the main factors you look at. And then I'm trying to think. It's easier if I'm looking at a list of them. Population, job growth, job diversity,
You're
crime
looking at some
rate,
household incomes and things like that as well.
medium household income, medium household, values, and
Sure.
things like that. So we analyzed, must have been 100 markets, and the ones I land on that I like, the ones we landed on that we liked. I have a partner that I work with, Andrew. He is actually he's out of Utah, and he is my acquisitions director. He has got a strong banking and underwriting background, and he's got a ton of broker relationships, and he is an underwriting machine. I don't know how he does it. We get in 2 to 3 deals a day, and by the end of the day, he's got an answer for each one of them.
Wow.
We'll buy this cap rate. I actually, it's funny. I just sent him a email this morning saying, "Hey, if you want to teach me how you're doing this, then I can underwrite half of them. I feel bad. I feel like you're doing a lot of work."
Interesting. So also, in all this, Sterling, broker relations are important, right? So give us some tidbits for, let's say, initial investors as to how they can, get deals and reach out to brokers and things like that.
So again, we've utilized a lot of Andrew's existing broker relationships. I've reached out to some brokers and invited them onto my show, just to give a different perspective from the other side of the table on commercial real estate. What we initially did was we went on to CoStar and identified the top brokers in the market, because those, with the highest volume, that's the ones we wanted to be working with.
Sure.
And we just reached out to them and explained our criteria. And, a lot of times we also ask for referrals. So I get to interview a lot of really credible guests on my show. So
Sure.
I ask them for a referral. And when I reach out to a broker and say, John Cohen told me to call, he said, "Oh man, I work with John all the time. He's a great guy. If you're friends with John, you must be legit."
Sure.
So
that's nice to know. So which states currently, or which submarkets you're liking right now, Sterling, that you're focused on?
Yeah. So our initial market evaluation led us to somewhere between Lexington and Louisville, Kentucky.
Okay.
Although we're rethinking that market at right now, just based on some crime. And then we really liked Huntsville, Alabama, and Jacksonville, Mississippi. Okay. And no market's perfect. They all have their unique challenges. Jacksonville is super competitive, and Huntsville's hard to get to, and so we're kind of reevaluating. We're looking at different markets, but Andrew loves Alabama because of the low taxes. He said it's just easier when he's underwriting to get the numbers. We started in Texas, but he said the high taxes were killing all of our deals.
I see. Gotcha. That's awesome. So now I wish you luck with the journey. I think sometimes getting the first one and then moving on, and it gets easier and easier. For newer investors, I know you said, by the way, all the viewers should listen to his podcast called Rent Roll Radio Show. I have seen a few of your episodes, very, very good guests, and good editing, and truly I enjoyed the shows actually, Sterling. So it was a pleasure to kind of listen to those episodes as well. So now moving on, Sterling, how are you attracting investors? So for example, if there is a new person listening to this podcast, what would be your advice to those sort of newbies, that how they can, thought leadership platform would be one, but how about if they want to, raise more money or get more investors beyond their sort of circle of, let's say, friends and family? What would be some strategies you can advise them?
So I don't know that there's some strategies I could advise outside of that. I've seen a lot. I've seen these click funnels, these aggressive marketing campaigns. You know, I just paid somebody to redo my website with an investor portal of, you know, to attract investors and stuff. But I think what it really comes down to, you know, a lot of my projects that I work on locally, I do with investor capital.
Mm-hmm.
And, you know, when I first started, nobody even considered giving me money.
Sure.
And now I can't find enough deals to support all the people that want to invest with me. And I would say, you know, one thing that really, I think people overlook, and hopefully, nobody listening to this show falls in that category, but I see some people trying to raise money and I go look at their Facebook page and they've got some obscene comments on there, or they've got some really radical political views one way or another. Just, and I'm thinking like, you know, if you got to really, really watch your brand and reputation.
Absolutely.
Every interaction. And, you know, another thing I see sometimes is when you're doing a deal with somebody, it's not always the best. Like getting every penny out of the deal or the negotiation is not always the best thing for your long-term business growth.
Absolutely.
Sometimes I have a tendency to pay people more than they ask for, or to give up more of the deal, you know, because I think the goodwill is worth more to me than the couple grand. You know?
Couldn't agree more. Couldn't agree more. And we see a lot in sort of the contractor relationships as well. In fact, I mean, I'm sure you have run into where I think don't make a big deal of the little things. I mean,
Right.
learn to like just kind of treat it as like a speed breaker of sorts, that if the contractor or is the work is good, you know, just work it out and look for the long haul. I couldn't agree more there, you know.
Yeah.
So, good, awesome. So, other than that, like, what sort of like some of the best advice you have gotten from all the different podcasts or different investors that you may have met? Give us some tidbits as to, you know, what best advice you have received so far from others.
I mean, there's way too much to go over on this show. It's hard to pick, but
Sure.
so I'll say one that I like from a very recent interview I did with Jay Scott.
Mhm.
And the interview hadn't even been released yet because
Mhm.
we're backlogged for a few months. But he, you know, I've always been a buy and hold investor. I've never sold anything,
Sure. Mhm.
and you know, I'm to the point now where, especially when I'm trying to transition to these large multifamily syndications, I'm like, oh man, if I sold a couple of these properties, then I'd have a down payment, or maybe I could invest passively in somebody else's deal to learn more, get more creative or something. So I was really struggling with the whole like never sell anything, keep building your portfolio concept. And
Mhm.
when I interviewed Jay and asked him what his best advice was, and Jay Scott, for those of you who don't know, he wrote the book on flipping houses.
Sure. Mhm.
He's a huge Bigger Pockets contributor. He wrote several other books as well that are great: recession proof real estate investing and the book on estimating rehab costs. But the guy who wrote the book on flipping houses said that he regrets selling every house he's ever sold. So that made me feel a lot better about holding
Right.
on to everything, just because, you know, the beautiful thing about real estate is long-term wealth growth. You know, you're paying
Sure.
down your debt, it's appreciating, you know what I mean? The cash flow coming off of it. You can sell something for a quick 50 grand, but if you just sit tight, you know, it'll make you several hundred grand.
Sure. And I also like to, you know, sometimes compare contrast that also by saying is that some people play the game of, okay, hey, you know, you refinance it every few years and things like that, right? Sometimes, you know, okay, you do need cash to get out of a bind and things like that. I get that part. But the more you keep on doing it, that's where it sort of starts to counteract against you, because you know you're increasing your leverage, you're never really paying that down and things like that. So you kind of are starting to negate the long-term benefits as well. Like personally for us, I mean, once we you know, acquire them and kind of, let's say, refinance it out like one time and have a long-term debt, we never tend to you know, refinance them afterward. You know, I mean, we are at a point where I think all of our loans are like less than 50% of you know, when we financed them before. So like given the long-term sort of track record we have within our portfolio, we see those benefits as well, that hey, the debts is paid down, and the quality of properties is great, and it's been going on and on. So just wanted to share that. So good.
Yeah.
Thank you. I appreciate your time, Sterling. Tell our viewers how they can reach you and learn more about you.
Sure. So they could find me a lot of places. So you could email me at sterling@crestworthcapital.com. You could call me at 225-247-5562. I love talking to investors. I love talking real estate, and all of my friends and family are sick of it. So anybody's just starting out that wants advice or just to talk something through, don't feel like you're bothering me. Love to hear from you. Or you can go visit our website at crestworthcapital.com, or check us out on Instagram or Facebook at Rent Roll Radio, and download our podcast, The Rent Roll Radio Show.
Awesome. Thank you. It's been a pleasure, Sterling, and I look forward to speaking with you. Hopefully in next year or so, and hopefully you have some more deals.
We'll talk before then, because I got to get you on my show.
Thank you. I appreciate that. Thanks a lot. It's been a pleasure.
All right.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.